All right, ladies and gentlemen, Friday is here. Who's got something good for us? There's some good vibes going on in that world. All right, well, I'll do it. I told you guys I'm going to start doing my gratitude. I wrote down a few things this morning, and I will tell you I am grateful for one thing, which is no more caffeine headaches. So, what do I mean by that? I have decided to try to go caffeine free, at least in the morning coffee. I think I just enjoy my coffee. So I will continue to drink, but we're going caffeine free in the morning. First couple of days were pretty brutal. I'm going to do that afternoon caffeine, but if you're getting a good night's sleep, you shouldn't need that caffeine in the morning. So I am through my caffeine headache. That is what I am grateful for. I'm going good in my life today. Anybody else? Anything that you want to share? Could be quirky as that. Sue.
Well, I'm grateful my mom came home from rehab, and I'm grateful that I have a schedule that I can be here for her.
That's awesome. Yeah, I mean, we talk about it on this call all the time. I mean, these lives are finite. You can look at it as they are long or they are short, however you want to look at it. But being present and having some flexibility with this job, we're pretty lucky. So
I don't know.
I'm glad for you as well.
She's 90, so to have her, to be with her for her last years would be nice. It's very rewarding.
Great. That's great. All right. Well, it is Finance Friday. We are joined here by Dan and Eric as we're going to do here regularly. So is anybody, well, I'll kick it off. We had something come up, guys, yesterday with regards to rate lock extensions. We're just trying to understand, we typically, when we put a deal together, we're not asking you guys, hey, how long is this rate good, right? We know this is the rate. We know we got a closing date of X. We should probably know how long that date is good for, right? And sometimes knowing that information could help us to maybe speed along the process with the client, or when as the market shifts a little bit here, we might be able to put some terms into our offers that right now, when we were a multiple offer situation, we can't go to the seller and say, oh, and by the way, if you don't close by this date, my rate lock goes up and you guys are going to be on the hook for it, right? And put some pressure on the seller. But we're starting to get into a place where maybe we could start to do that. So could one of you guys tackle this? I'm assuming it's kind of market dependent, but I'm assuming there's also on every deal, do we have a date? We know this rate is good until this date. So who wants to take it?
I'll jump in quick. So I think when we get the contract, at that point, now we know our target date. So we know if we need a 30-day lock, we know if we need a 45-day lock, a 60-day lock, or if it's maybe contingent on the sale of their house, things like that. So I know myself, and I know Dan does this also. We have a conversation with the client. We say, hey, here's where the rate is today. Here, would you like to lock? Obviously, we're in kind of a volatile time when it comes to rate locks. The market's always shifting. And to be honest, a lot of clients will say, hey, I'd really like something lower. Okay, great. Understand that we're floating. And we'll stay in communication, and we can check it, every day, every week, whatever the client's comfortable with. So if they're floating, we're going to have communication with them every day or every week about where things are until they lock. Once somebody locks, now we go, okay, your contract said you're going to close on, we'll just use fictitious dates here, November 15th. So we locked your rate through November 15th, 16th, 17th, whatever it might be, at least through that date. Now, if for any reason we can't close on that date, and obviously if it's the buyer's fault that we can't close on that date, something was being delayed, then it should be the buyer's problem. But if it's the seller's problem, all of a sudden they need an extra week, then the cost should be passed along because the buyer performed. So that's probably the only time I would have that conversation with the seller side of, hey, their rate lock needs to be extended. There's a cost associated with extending it. They're ready to go, but you're not. So it's all about communication. It's all about keeping it transparent, making sure everybody's on the same page, and understanding what we're doing. But if we do need an extension, there is a cost. They don't just extend the rate forever for free. And a lot of times, like we have clients right now that are closing that maybe they locked 30 or 40 days ago when rates were better, because rates are actually worse now. So it makes sense to pay that extension fee because it's better than taking the higher rate.
Thank you, Dan. You want to add anything to that, or?
Yeah, and a lot of times, as far as like the period on the rate lock, like Eric said, I mean, we're usually locking for like 30 or 45 days in most cases, and we try to play it accordingly so that we're not having our rate lock expire on our target closing date. We usually try to give ourselves a little bit of leeway, so where that we get a few more days on the back end of it, or up to a week or so. Just like I have one right now with Amanda that we have targeted to close on Tuesday, but it took a while for us to get the title in from the title attorney. And then when we got it just this week, it had another parcel on the title that nobody really had realized was being conveyed to the buyer. So therefore, now we had to go back and get an addendum done to the contract that had to get signed by all parties. I had to get that addendum over to the appraiser because that now has to be noted on the appraisal. A lot of extra work that kind of goes into it at that point, which could have potentially I just threw it out there because the seller was kind of taking their time on getting that addendum back to us. So I told Amanda, I was like, hey, listen, if we don't get this back soon, we may end up in a position where we're not going to be able to close on time because we need this ASAP. Just kind of a little bit of a fire, and then they were able to get everything sent over, and we should still close on time. But even if we don't, like I have that rate locked all the way through next Friday. So even if I did need a day or two for this type of situation, we're covered for this buyer because of the rate lock time frame that we got for her to begin with.
Yeah. Yeah, so so good info there. And Eric, the first thing that came up that you said that just kind of made me go, that's not going to be a great situation for us as agents, is where we've got we've got a closing date for the 15th, let's say, of November, and we set it for the 20th. Let's say we're locking the rate through the 20th of November, and now we've got that title issue, and it's the seller's fault. But if at that point, and it's going to cost $800 to extend, let's just say, and we go to the seller, they're going to go, okay, that's too bad. Sucks for you, right? Like, they ain't going to pony up. Now, if we had time is of the essence in the contract and we said, hey, if you don't perform by this date, my rate lock is going to extend. It's going to cost me X. It's going to be on you. And we had that conversation up front when the seller has no expectations. They think they're closing on time, right? So now we've got them, by the what. So, and Megan's kind of putting in the chat something along the same lines. Why not, and I'm assuming there's a cost to it, but why not go 30, 60 days past the closing just to be safe, right? It typically doesn't get extended that far.
The longer your rate lock period, the worse your pricing gets. So when we want to get the most competitive pricing for a buyer, we want to lock it for 30 days. When we extend a rate lock period out to 60 days, the pricing isn't as good. Basically, the market's hedging in any potential changes, and they're like, all right, well, if you want to lock for 60 days, your pricing is going to be a little bit worse than if you lock for 30 days. So typically that's really why we don't just take everything out to the longest rate lock possible, because financially it doesn't make sense.
And how far out can you do it? Like when you're looking at your screen and these are the rates, right? Is there 30, 45, 60, 75, 90, 120? Like, what does it look like to you guys?
So I'll jump in on that one. So the standard is 75 maximum. And just to,
75 days is kind of the max.
75 is your max. If you want anything longer than 75, you actually have to pay a forward commitment. So I've had people where, we were in a very volatile rate market and they're like, listen, I need to lock for 120 days. They actually had to write a check to pay up front a lock-in fee. But the problem with that becomes like none of us have a crystal ball. If I knew where rates were going to be in 3 months, I'm going to be honest with you, I wouldn't be doing mortgages. I'd be trading securities. And I'd be making a whole lot more money. So for me to even tell, and I'll say that right to a client, I'll say, none of us know if this makes sense, if this is good for you, because God forbid we lock them in for that long period, and they take a slightly worse interest rate or cost, and then 45 days in, they're like, oh, look at that, things got better. Well, unfortunately, when we lock somebody, it protects them from the rate going up, but it also kind of inhibits them from floating down. If rates do get substantially better, we do have a float down option, but it's not quite the same as, hey, I'm going to switch lenders and I'm going to go find the best deal now that things got better. So it's kind of like a double-edged sword.
Meg, did that, I see your hand, Lauren. Did that answer the question? You have any follow-ups? I don't know if you're in a position to talk.
No, that answered my question. And, the fact that they do have a float down on those longer, potential for a float down on those longer rate locks. That was something we utilized on the new construction side of things. That was really helpful for a lot of our clients.
Yeah. And I'm assuming that's like, there's a fee involved with that if you've got to, execute on that.
There's a small fee, but I'll be honest. Obviously, when you have clients like that and you want to maintain the client, it's such a small fee. 90% of the time, we'll absorb it. We'll take care of the client. The client has to come first.
Lauren, what do you got?
So actually a two-part question. The fee for a rate lock extension, and I guess maybe just for more understanding for myself, who does that go to, right? Like when you collect that, who's collecting that money and what are you actually paying for? Are you like prepaying interest for the set amount for a difference? Like what is that fee covering?
So that cost is listed on the closing disclosure. So the buyer's paying it, and we're literally not making any money off of it personally at Semper. We're passing that rate through to the end investor that we're delivering it to, and it is prepaid interest. So basically it's, hey, we needed an extra 7 days. We'll say it's, we'll use round numbers. Maybe it's $500. It all depends on the loan size because it's based on, per day. And that's basically all it is, hey, we need an extra 7 days. We're just going to pay the interest for those 7 days.
Now, does the fee differentiate based just solely on what the number that you locked in at? So if you have a lower interest rate, right, your fee to extend your lock-in would be lower than if you were prepaying higher interest rate? Does that make sense the way I asked that?
It's more based on the loan size.
Okay.
So 7 days is going to cost 0.2%. So, we're used to, in real estate, 1% or 2%. So in mortgages, it would be 0.2%. So 1/5 of a percent. And so if it was $100,000 loan, it would be $200. If it's a $500,000 loan, then it would be $1,000. So it's not really based on the interest rate. It's more based on the loan size.
Perfect. And then slightly unrelated to that, but thank you for answering that because that was very clear. How often are you running into a situation where we lock a rate in, and then rates go down without that float option in place, and you're having to have maybe a difficult conversation with a client that's now locked in a little bit higher than they're seeing in the market?
So, I mean, I trust me, I wish we were having this conversation more often because that would mean that rates were dropping, which is what we all really want. You know what I mean? I would love to have these conversations. It's a stressful month when that happens, when rates suddenly significantly drop and you've got to have all these conversations. So trust me, I look forward to that month because it'll make all of our lives better. But at the end of the day, once again, we're always going to put the consumer first. We know that we've all done a lot of work to find this consumer. You've done work to get this consumer over to us. We've done work to get them, halfway through the loan process. They're approved. Things are moving along. We're not going to ever lose a client over $1. We're going to make concessions on our end, whatever we've got to do to keep them happy, to take care of the client. We're in this for the long run. We're not worried about what we're going to make on one client. We're really here as a partner. We're trying to take care of the client. You get a good review, we get a good review. They refer people. We'll make our money over the long term. So we're always going to float down. We're always going to figure out a way to keep them happy. So don't overthink it. Don't worry about the exact cost associated with a float down, because we'll bend, we'll bob and weave. We'll do whatever we got to do to keep the client happy.
Thank you. I think those are my only questions.
Dan, did you want to add something there?
Eric pretty much hit on it. I was gonna say, it's a good problem to have when the rates are going down and we got people asking for lower rates, because, like, again, he was saying we do have the flexibility where we are a direct lender, we are your partner, we value the client and what we're all doing together, and we're never going to lose a deal over being flexible on the rate or a rate lock extension fee or something like that. Like, we're all in it to get to the finish line with a happy customer that's gonna remember us and refer us out.
Pat, I see your hand up.
Yeah. When are you typically locking a rate? Is it when underwriting gets involved after after inspection's over? Is there a rate lock on every single loan that you do?
Well, yeah, every loan needs to have a rate lock, period. You can't close without having a rate locked in. And I mean, technically it has to be locked at least 4 days before closing, because you do your rate lock LE and then you can send your CD the next day and get yourself to closing. But as far as when we lock the rate, we can lock it once you have a contract and a closing date. And we know that we're going to lock it for an appropriate time to get you at least through that closing date. Like I mentioned before, typically we like to give ourselves a little bit of a buffer on it as well. But we don't necessarily have to wait till we go through underwriting. We don't necessarily have to wait until you've done inspections. Once we have a signed application by the borrower and we've got your contract and we're submitting that loan into our underwriting, at that point, it's kind of on me or Eric as the LO to work with the customer on when we're going to lock that rate, the rate that we're trying to get them. Like, if it's on like the threshold where it's like, oh man, one bad day in the market and this rate's going to be gone and I'm going to have a tough conversation, and hey, now you have to pay a half a point to get the same rate as yesterday. We want to try to avoid that. So if I know that I'm kind of teetering, then I'm going to be more attentive to making sure I'm getting that rate locked in before it changes for the borrower, and to lock it for a long enough time. Sometimes it gets to where, like, we talked before about, doing like some extended rate locks, and there are options up to 75 or more days. But like we mentioned before, the pricing gets worse. It costs the consumer more money as well. So, usually if we are in like a contract that's 60 plus days out, we're most likely going to float that rate for a little bit, because even if the market moves marginally, it's probably not going to move as much as they'd have to pay in additional to get a 90-day rate lock on it. If that makes sense.
Yeah, right. So if I'm looking at, we got a 60, or well, let's call it 75-day out close, and my rate is, I don't know, it's 6%. If I want to be able to lock it for 75 days, and it's whatever, 6.2 would be a little bit, or it'd be a little bit lower, I guess. It'd be 5.8 or something if I only wanted to do a 30-day lock. So you're like, hey, let's just float this a little ways, because even if I get out, maybe now to get the 30-day lock, it's that same 6%, right? So we can float it for a little while. Yep. What about the scenario where we've locked it for, let's say, 60 days. It's going to go over a little bit. And Eric before said, hey, rate lock is typically due to loan size. But if rates, does where rates have gone, I guess, affect the rate lock? Let's say rates went through the roof and now I need an extension. Is it more expensive, or is it still just based on that loan amount, versus if the rates had stayed flat, or even if the rates had gone down and I'm just asking for another week, right? If I'm an investor and you need another week and but I still get my higher rate, it seems like that almost shouldn't cost anything. Shoot, yeah, we'll give you another week at that rate, because rates have actually gone down. So I'm just wondering if it's loan size plus what's the market done.
So the market really has nothing to do with it. That's the whole point of locked. You're locked in based on that day. So if you locked your rate on, we'll say we're in October right now, October 15th. So now your rates are based on October 15th. So even if you need an extension, it's just based on that cost associated for the days, because you locked in on that 15th. So when we deliver these loans to our investor, we've already locked it with them. They've already put it in their pool. They're going to send it to Fannie Mae or Freddie Mac, and it's based on that forward commitment from that day. So the customer doesn't have any worries. It's not going to be, oh, the market went really, really bad and now you need an extension, so now you have to pay for the days and the fact that it went bad. That's never going to happen to them. That's the whole point of locking. It's to protect them.
Good. Lauren.
One more. What happens if a rate lock expires? We don't pay for an extension, right? So say for hypothetically, like we had to extend a closing an extra month, our rate lock expires today. Could you just relock it again in the future within those 4 days of that closing? Like, I guess more so like what happens if a rate expires?
So basically, the investor, to us, they would just call it worst case pricing is what you'd get. Again, though, we're flexible. Like we can work with our clients, especially in a scenario like that. We get to the finish line, we're gonna do what's needed to be done to get that client closed with us. But technically, like for us, it's worst case pricing. So like if when you lock the pricing was worse than it is today, they're gonna revert you back to your original lock. That's when you have an expired rate lock. That's why we really try to avoid letting any rate locks fully expire, because we get like that worst case pricing on it. One other thing I wanted to add on to what Eric had said about, we're going back and we're locking the rates in for that customer based on their rate lock day of, say, October 15th in that example. We're locking all pricing on that day. So like if, I've done it where, say, we've got a client that's like a 695 credit score. And it's like, man, if I can just get you up over 700, I'll be able to get you a lower interest rate or better terms or whatever. We can lock in the pricing on that day, and then I do a rapid rescore for that borrower within the next week, and I get him from a 695 now to a 710 credit score. I can still revert back to October 15th pricing and get him the pricing based on a 700 plus credit score on the day of his lock. So we really are locking all the rates for that day for that client. And then if, they said initially, I would like to pay a point to get the lowest rate that you've got today with a point on it. And then, after they really further analyze their financials and they see all their closing costs all together and like, oh, shoot, you know what? I don't think I want to pay that point anymore. We can just easily, again, revert back to that day's pricing. Say it was 7% with no points, or it was 6.5 with a point, and we're processing everything at that 6.5. We just revert back and say, okay, no problem. We'll just change it. We'll go to this 7 and we'll drop the point, make some revisions, and send you some new documents. But But that's all going back to, again, locking in all the pricing on the day that we lock. And then the extension fees, I know Eric had used in his example a 7-day extension fee at a cost of 0.2% or 20 basis points, we'd call it. So the cost of your extension also will depend on how long you're going to extend that rate lock for. And again, the longer time, the more expensive it costs. I want to say a 15-day rate lock is going to be like 0.37%. So not quite double a 7-day rate lock, but it does cost more. And then again, for a 30-day lock extension would cost even more.
Dan, you mentioned something in there regarding credit scores. Is there kind of some tiers that are just standard 675, 700, 7.25, 750? Is that,
Yeah.
or like every loan and every and what are those increments that are actually going to make a difference? And the reason why I think this one's so important, when you guys are picking up new clients, right, explaining that credit score does matter. This is why you want to get pre-approved now up front, because if we can figure out a couple of things that we can improve, we can save you some money. So I get it that you don't plan on buying a house for the next 6 to 12 months. I still want you to talk to my preferred. Let's see where you're at. Let's see what you could be able to do over the next 6 to 12 months while you're waiting to purchase, to get you into that better bracket to save you, an eighth, a quarter, whatever it might save you. So could you just talk about like, what do those tiers look like and what might be the difference in a rate on those tiers?
So they go pretty much like in 20-point increments. So like a 680, 700, 720, 740. Basically, once you get over like that 740 mark, everything's pretty much the same. But like if you're under 700, like that 700 is kind of like the cutoff. Like if you're under 700, for the most part, you probably are going to want to do like an FHA loan to get some competitive pricing on it. If you're like a 680 something and you're looking to get a conventional loan with like a minimal down payment, your pricing is not really going to be very good. And even in some cases, it might just not run through the conventional Fannie Mae underwriting system for an approval at that point. With like a fair credit score and even a moderate down payment, sometimes they won't take it. So really those thresholds are, you want to say like 680, 720 for the most part. If you got somebody that's 720 or better, conventional loan like that, they're going to get some competitive pricing. Like they won't have any issues. If you're under 680, you're probably like an FHA buyer for the most part.
I want to jump in on this. So if I sent you the, I guess I always joke about it's like an abacus. We've all seen the picture of Einstein with the chalkboard with 90 million things written on it. That's kind of like if you had to manually do an interest rate for somebody, that's kind of what it would look like. It would be Einstein with the chalkboard with 800 things drawn on there that you kind of just can't even understand, because they call them, it's loan level price adjustments, LLPAs, and it's based on credit score, it's based on number of units, it's based on whether or not you're going to occupy the property, it's based on if you're doing a purchase or you're doing a rate and term or you're doing a cash out. So there's literally, if you literally Google LLPAs, you'll get these two charts, and you have to combine this chart with that chart and their pricing adjustments. So you take the interest rate and whatever that's paying, and then you deduct out all these things, and then now this is what it costs the client. And it gets significantly more expensive the lower the credit score when you're doing a conventional. But you almost need like a degree to understand these charts. Luckily, we have a pricing engine that we pay for monthly that takes all of this and kind of does it in the back end. And it goes, hey, what's the credit score? What's the loan to value? And what type of loan are you doing? Boom, here you go. Nice and easy for you. You don't have to think. But it's that in depth on the back end when they're out there, when these banks are buying these loans and choosing what they're going to pay for each loan. So it has a huge impact on the client. Their credit score is very, very important.
Amber.
So we're talking about credit scores and things like that, but how much of a difference does it make? Say they have, 700 or better, but their debt to income ratio is too high. So, we have those clients that either have, a low credit score, a high debt to income. We have the ones that are perfect. What if they have the great score, but their debt to income ratio is too high? And where should it technically be? I think it should be under a certain percentage, and it depends on whether it's conventional or FHA. But can we talk about that a little bit?
Yeah, sure. I mean, so if you had like a really good credit score buyer with just kind of a high debt to income ratio, I mean, we're gonna consult with them and we're gonna go through maybe what we could do to manipulate that debt ratio. So if they have a good chunk of money, maybe that they were intending to use for their down payment, but we can say, hey, if you, instead of putting all that money on your down payment, take some of it and pay off this or that liability to get rid of these monthly payments that you have on this end. Now you don't even have to put it all down on the house. You've your debt ratio just by paying off some certain liabilities. If that's not an option, certain loans will approve higher debt ratios. So like on an FHA loan, you can go up. So there's, as far as debt to income ratio, there are two of debt to income ratio. There's front end debt to income, is just mortgage with the taxes and insurance and any HOA or PMI, like the total housing expense against their income. And that's the front end debt ratio. On an FHA loan, that can go up to 46.9%, which is really high. And then on the back end debt ratio on an FHA can go to 56.9%. Now on conventional loans, both front and to be
And Dan,
under.
and Dan, on the back end, that's obviously including some additional expenses, I'm assuming, right? The first one was just
Yes,
kind of
yeah,
the
I'm sorry,
housing,
yeah.
and then
So
the second one takes.
takes into consideration everything else that they're paying: car loans, credit cards, auto loans, student loans, if they have child support that they owe, alimony, things like that. So that takes into consideration, right, everything else. And that's where we can really manipulate that debt ratio. There's no way that we can manipulate the front end debt ratio, because that's just the mortgage payment against your income. There's only so much we can do, I should say, about manipulating that, because we can look to get a lower rate, a little more down payment, and so forth. But on the back end, that's where you can look at their whole list of liabilities and say, Mr. Borrower, if you want to get this house at this, you're going to need to pay off 1, 2, 3 credit cards or whatever it is. We can always look at that on a case-by-case basis. But in general, FHA loans are going to approve a higher debt to income ratio than conventional does, and they're a lot more flexible with the credit scores too.
Let's just wrap with this final thought. And I know there's a million things that go into these rates and everything, but I want to make an assumption. Two assumptions. We get the two identical borrowers. One has, they're both buying a $500,000 house. They're both putting down whatever 10% or something. One has a 700 credit score and one has a 720. Everything else is identical. Are they getting the same rate, or are we going to save an eighth for the 720?
Yeah, they're not going to price out the same. So the rate would be a little bit different, or we might have to charge a little bit of a discount fee to get him the same rate as the 720 buyer.
So literally
But
20
those
points
are,
in your
because
credit
those
score.
are right on those thresholds. Yeah.
Yeah. So 20 points on your credit score, you're getting a better rate, or the other guy's paying to get the same. Yeah. Okay. And then let's use the same example. They're exactly the same. Their credit scores are the same, but this time their debt to income ratios are 5% difference. So
That
one
wouldn't
person
really
getting a
affect their
better.
pricing.
Okay.
No, as long as their debt to income ratio is being approved, is
Under.
approvable for the loan program that they're doing for a conventional loan, then it's not going to affect their price. It's not like, oh, this person's only got a 30 back end DTI and this person's got a 40. They're going to get better pricing. It's more so based on the credit score and then the amount of the down payment. Like, especially with conventional loans, like, you get a little better pricing. Sometimes you put down a little more money.
Yeah.
But
So
again,
guys,
it's all
I think
like Eric said, there's a
that's the
whole
power. That's the power, guys, when you're talking to somebody up front, in my opinion, and they're like wishy-washy about getting pre-approved now because they're not going to buy for 6 to 12 months. We've got to have this conversation. Just go talk to the lender, right? Because I'm assuming, right, if they're at 640, right, and we can get them over 700, we've got them from the FHA to a conventional product. If they're at 680 to 720, right, maybe at 680 they're still in a conventional, they could squeeze in there. But now we've got them an eighth, a quarter better on their rates. Like this is a lot of money we're talking about for just having a conversation with the lender. It could be saving you hundreds of dollars a month, and that's why I recommend to all of my clients that you go and do this now. So just
we always
scripting.
suggest that it's never too early to have the conversation about getting pre-approved, because it's just gonna get all the information to the surface that borrower really needs to know, and they might not even know that they have questions, or that they might have stuff they need to work on. But until you identify it and give them a plan on what to do, then they don't know. Or if they are just well qualified and they don't need to do anything and they're ready to go right away, at least now they know that, and so do you as the agent, and you have them pre-approved. And if they're not super motivated, but at least if they saw something that they like, that that you can take them and show it and make an offer right away.
And I want to just jump on this just because we have a decent amount of people on the call. So when you're having the conversation with the client, I know most clients' apprehension is, well, I'm not ready to go right now. I don't want to have my credit pulled. It's going to hurt my credit. I want to really, really stress the fact that at Semper Home Loans, we do a soft credit check. It's called a pre-qual. And it has no impact on their credit. There is no hard inquiry. There is no points lost. So it's literally free for them to check and with no negative effects on them. So that's super important. They can kind of see where they're at, and they don't have to feel like they had an inquiry. Like if they go to their local bank, they go to, Bristol County Savings, they're going to do a hard inquiry, and they're going to lose, their 5 points, and then it's going to rebound. But they're going to have that hard inquiry. They're going to get that notification if they have any credit monitoring. We do a soft credit check. They're not going to get they're not even going to get a notification that they had an inquiry. They're not going to have that hit. So we can really, really stress, hey, listen, you can find out where you're at. You can put yourself in a better situation later down the road, and it's going to have no impact on you, because that's usually the apprehension there, because out in the normal banking world, they're going to get that hard inquiry. But with us, they're not going to have that hard inquiry.
But also the hard inquiry too, that triggers every lender that is out there looking for new clients. They're going to start calling. They're going to get on all those call lists. Like once you do that, it puts them literally on a trigger list, it's called. So, and that happens when you do the hard credit check, but not the soft.
Hey guys, really good session today. I didn't think we could talk for 40 minutes on rate locks, but we did it. But hopefully everybody on the call learned a little something today. There was a lot of nuggets in there. Being this community is just amazing for this stuff. Appreciate you guys coming on. I appreciate everybody coming with some great questions today. And I'm looking forward to more of these. And I think as a group, guys, we got to look to bring on some more guests. It's going to be one of my goals for this community and for this call. So if you have ideas and something that you'd like to talk about, go in depth like this, so we can just open it up, please bring them to me, especially if you have the actual person that you'd like to bring on the call. I'm excited for what we can build with this community moving forward. So thank you guys so much, and everybody go crush your weekends, and we'll see you again first thing Monday morning. Take care.
Thank you very much.
Thanks, guys.
Have a great
And
weekend.
any other, we'll see tonight up at Springfield. Hopefully we'll see you guys there.
Thank you.
Thanks a lot.
What do you mean? What do you mean we'll see you there?
Bowling tonight.
Jeff.
MGM.
I thought that Jeff and Linda's Mike was going on that. So I was like, are they flying up?
It was going to be a comedy. It was going to be a comedy show, but the comedian canceled.
I know we're going.
So,
I will be there.
So now we're going.
I will be there.
The comedy show is going to be the comedy show is going to be me bowling.
Okay. All right. We'll see you guys there.
All right. I'll see you guys later. Bye.
Bye.